I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on Cyclesman.com. Welcome to the show, Tim.
Jim, as always, thanks for having me.
Interesting that we talked before we went on air about timing. People are saying, bail on stocks, stock up on gold and silver, maybe bullion, maybe gold and silver miners. But our question is, when do you do that?
Well, you know, in my work, I have cycles, statistics, and, the norms of the past and the ebb and flow of the cycles. And, while I'm bullish on gold moving into the future, I'm just not sure we're there yet. You know, we have this pesky little thing called the 9-year cycle. And, it peaked back in 11. And I said that, every rally from that point would be counter trend. And we would go down into 16, 17. And we have. And it's now obviously 16. And we've bounced. But I have yet to see the evidence that we've seen the final 9-year cycle low. It's possible, but I don't think so. It hasn't proven that to me. And based on the historical ebb and flow of the cycle and, the associated norms and the statistics and so on and so forth, there should ideally be another push down in gold. Before, we have the final bottom. Is it possible something a little different is going on? Yes, it's always possible something a little different is going on, but it hasn't proven that yet to me, so I have to stick with the work, stick with the statistics, stick with the cycle. I think we need to be on guard of getting overly bullish too soon, at least in my eyes, until we see evidence of that final bottom. Now, one may argue, well, that's splitting hairs, and maybe it is, but I would just hate to see people panic with a final push down and say, oh, my God, we were wrong, and get washed out. Because once we get the 9-year cycle low, I agree. I think gold stocks, miners, gold itself, silver, maybe even commodities as a whole would be a place to be. I'm thinking that we see the washout with commodities, gold included, into later this year along with equities. I think it all flushes. Some will argue, well, it won't happen that way. When equities go down, gold goes up. Look at your charts. Everything went down in 8. Everything went down in pretty much in 1 and into the gold actually did bottom in 1 ahead of the equities in 2. But be careful with those relationships because the ebb and flow of the cycles, they're not always exact, and the relationships are not always exactly the same.
Well, Tim, I've seen on the equity markets days where the equity markets are down and gold has gone down at the same time. So if people think that there's a reverse correlation between the two, you're absolutely right. It doesn't always work that way.
It doesn't always work that way. Sometimes these relationships, it depends on the cycle. Has the higher degree cycle bottomed or topped? And sometimes they're in sync and harmony, if you will, and sometimes they're not. And sometimes it takes, one will bottom a little ahead of another one or top a little ahead of another one, and then they'll get in sync. And so people make the mistake of drawing these absolute correlations when they shouldn't. And, one example of that if you look back, I'm pulling up a chart as we speak, but if you look back at the dollar and crude oil, one of the reasons that people were talking about, back in 2008 is they were saying, well, they were justifying the price of crude, and they were saying, well, it's because the dollar is so weak, the dollar is so low, and the dollar is going to crash, and the dollar is only going lower. Well, in reality, that wasn't the case. The dollar was making a 4-year cycle low, which we said back then, but what people don't realize when you actually look at the chart, for example, the dollar was trading, I'm looking in 1995, and the dollar was in the low 80s, like 81, 82 on the dollar index. And in 1985, let's go back and now look at crude oil. That's when the crude oil crashed, actually, if I remember right. Yeah, in early 1986, crude oil was $13, $14 a barrel. So these relationships, you can get in trouble with that. Yes, they exist, but only when the cycles are in sync.
Well, I remember in 1995 filling up my car for the same price I filled it up back in the 80s.
Absolutely. I remember in 99, well, I'm looking at the chart as we speak. I remember, actually it was late 98, early 99, crude oil was again back down at $11 a barrel. And let's see, where was the dollar just for in late 99? In late 99, or early 99, mid-90, whatever, the dollar index was, where was it? 94, 95 range. So those relationships, again, be careful.
The world's finance ministers, at least on the G7, and the central bankers are huddled up in Japan. Do they really influence what happens to the economy? I know they think they do, but in reality, do they?
Yes, they do in a short-term way. Absolutely. I mean, they can come out and make an announcement, or obviously you can come out with QE 1, 2, 3, 4, 5, whatever, and juice the market to a new high and extend 4-year cycles and create housing bubbles and commodity bubbles, and yeah, you can do all those things. But it doesn't work. It just doesn't work. And a perfect example of that was the extension of the previous 4-year cycle into the 2007 top. All the manipulation and tricks it didn't work then. And like I've said before, show me one time in history, where manipulation ultimately did not fail. It always does. And, they can pull a rabbit out of the hat again and extend it a little more, and as they say, kick the can. It doesn't matter. It doesn't matter. It's not going to work. It's just not going to work. And in the end, it only makes matters worse. And that's what's got us here, is monkeying with things anyway. Remember the old commercial back in the day, and said it was a butter commercial, or Parquet commercial, I think, and said, it's not nice to fool with Mother Nature. It's not nice to fool with the business cycles. Let them alone.
Well, we've seen the disastrous policies in Europe and Japan of negative interest rates. What I have found out, though, is that it's actually a secret tax. The government makes a load of money when there's negative interest rates. It has nothing to do with boosting your ability to survive or make a living. It's a tax.
Yeah, I had no idea about that. I had no idea.
Right. They were saying in Japan, since they brought in this policy, the government has made billions of dollars because everything is working backwards.
Right.
And, so it's silent, it's secret, it doesn't show up when you pay your taxes every year, but it's sucking money. It's sucking money out of your bank account, and then that money that's sucked out goes to the government. It doesn't go to the bank. We'll have more with Tim Cyclesman Wood right after this.
I'm Larry Ray, President and CEO of American Manganese Inc., listed on the TSX Venture, ticker symbol AMY, AMY, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Tim Cyclesman Wood. Tim, what's your crystal ball tell you with cycles and the price of crude?
Crude oil, we had the seasonal and which is basically an annual cycle that tends to bottom. Well, it's two things. One, it is a seasonal cycle in that there's a seasonal tendency. Again, it's not clockwork, but you do tend to see bottoms early in the year, late winter, time frame, and then a rally into the driving season, summer driving season. I don't have it committed to memory, but you'll see that top then that follows run somewhere typically just there's a tendency. Again, it's not carved in stone, but to peak sometime in the May, June, July. I've seen it go as late as August, and again, every year is not exactly the same, but bottom late early in the year, rally into the summer driving season, and that's exactly what we've seen. Have we seen the ultimate bottom in crude oil yet? I'm not so sure about that. And I haven't seen enough structure here to say that we have, and so until I do, I have to assume that we have not. I think that this is a counter-trend rally. I still have an intermediate-term buy signal. It's very overbought. It's continued to push and push and push, and I do have a short-term sell signal on crude oil, occurred today, actually. But and then crude rallied off the bottom, so I don't know if that's even going to stick. We'll see. But as of the close on Thursday, we did have a short-term sell signal. The intermediate-term buy signal is still intact. So the intermediate-term advance out of the February low is still there. But Jim, I'm just not convinced yet that is the bottom there either. Again, I think until I see evidence to prove otherwise, that we're going to have everything has been up, just like equities. If you look at it, equities bottomed in January, February. Gold bottomed in, December. We had a crude oil bottomed in, kind of a double bottom in January, February. And everything is kind of bounced in harmony. And that just happens to be where those intermediate term cycles, and so they are in sync here. But I think that there is a tendency, or at least a risk, I don't want to say tendency, there is a risk that everything then goes down together into the end of the year into a final washout type thing.
Do you have any numbers?
I'll give some numbers on equities. Let me say this. If the statistics are fulfilled, we could easily see 60-70% decline in equities, unless this time is different. If the statistics hold, 60-70% type decline in equities. I know, it sounds insane. I almost don't believe it myself. I'm not sure if I do. But again, I have to stick to the statistic until it proves that it's not going to be fulfilled.
Of course, central bankers will probably try to throw everything, including the kitchen sink, at it. Would that be a mistake?
If we see that what they do is not going to matter, they're going to have lost control of the situation, and it's just not going to matter. They may as well just step aside if that were to happen. They're wasting their ammunition, so to speak. And a decline like that would obviously mean that something has happened and that, their efforts are futile.
Should central banks pretty well pack it in and decide that we should just have financial policy run by the government, not central bankers who don't have to pay the consequence of their actions anyway?
Well, I think most people should pay the consequences of their actions, but I'm a believer, however you want to look at this, in the free markets. I understand the central banks have their place. I get it. I understand the argument for gold is real money. I get that argument too. I understand all the arguments, but at the end of the day, as they say, I think the thing that trumps everything is that the markets need to be free. They need to ebb and flow according to the business cycles. There needs to be that boom and bust, and the piper has to be paid, and let it be paid. Just let the markets be free. We would have a much, much healthier economy and environment if that happened. Nobody wants to pay the price, but how do you have good if you don't have bad? You need that washout, and I think, based on history, the relationships of bull and bear markets throughout, the dawn of time, so to speak, since the inception of the averages in the U.S. anyway, that, the secular bear markets have run about a third the duration of the preceding bull market. And that has held true until we got to the 2000 top in this insane level of let's call it what it is, manipulation, management, trying to rekindle the animal spirits, to use the word. And I understand what they're doing. I understand, but it hasn't worked. And so now, rather than having gone through this, I feel like that based on history, if they would have just stepped aside, let the market done its thing, and the casualties been the casualties from the washout and the excesses, that we would have already bottomed, we would already be on solid ground, and they wouldn't be fighting this fight. It'd be done. We wouldn't have to be huddled, the central bankers wouldn't have to be huddled figuring out the next move and agonizing over how to keep the thing from crashing. They've created a worse environment. They need to leave it alone. And I don't want to see this happen, but it has to happen. Let it go. A crude example, and you may want to cut this out, but let's just get it down to brass tacks. It's like having a bad upset stomach and you need to purge, but you put a sock in your mouth so you can't. It's better to just get it out.
I was going to say something even grosser. It's like picking at a
cork in your butt when you have diarrhea, exactly.
Well, I was going to say picking at a scab. Just let it heal.
Right. And so, yes, they've done a masterful job at trying to manage and extend and keep things together. Absolutely no question about it. But it hasn't solved anything, and the purge still has to happen.
Tim, thank you very much for chatting with us.
Thank you.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Comments about the show can be sent to info@HowStreet.com. Our YouTube channel is Talk Digital Network. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.